Well, good evening, everyone, and welcome to this evening's open house Q&A session with the market guys. I really am I have been looking forward to this one because there's been so much volatility in the market since the last open house that we had, and I'm sure you're going to have a lot of questions, and hopefully you're going to have some stocks for me to analyze later in the session. But as I always do, I start off analyzing or reviewing the major indices so that you can see what the technical signals look like. And these lines that are on the chart now are from the recording that I did on Friday, which many of you received on Saturday, either Saturday morning or Saturday afternoon. And if you have been following along with the weekly market report, you'll know that last Friday, a week from last Friday, I said that the markets would rally, and that was because of this very long shadowed candle right there. That's kind of a mixture of a hammer pattern, a spinning top, and a long-legged doji, all rolled up into one. And that particular day happened on super high volume. It was like the third highest volume of the year, and that was a screaming buy signal right there. As you know, the long shadow underneath the candle tells us that during the day, the sellers tried hard to push it down to a new low right there, but the buyers came back towards the end of the day and fought back. And when you have the buyers overcoming the selling pressure, especially towards the end of the day, that's when the institutions start jumping in, and lo and behold, we had the buy signal right there. So that long shadow candle came right after a very significant bearish engulfing pattern right there, which was Thursday. And you see this long shadow right there on Wednesday. That's the long shadow above the candle, tells us that the sellers moved in. And while all this is happening, right from the breakdown of the 20-period moving average on February 2nd, right on to the low here on February 9th, we had a dramatic increase in the volatility index as prices dropped off, as people were more or less expecting a sell-off, but there was a lot of panic starting to come in there because you had the circuit breaker triggers starting to get fired, and people were in a state of confusion. So volatility increased, and then we, of course, rallied, just like I said. Now, just to review a little bit from what I said from last Friday's weekly market report, the reason I think the markets are going to drop from here this coming week is, well, there's many signals, but I'm going to kind of go through the way I read a chart. I first look at the individual candle as it relates to the moving average. And you can see that that candle, the high from Friday's trading session, touched almost to the penny of that moving average. And there's a thing called role reversal that I talk about quite often. And that concept of role reversal can also be applied to moving averages. So when the moving average back here on February 2nd was broken, that moving average up until that point was acting more or less as a support level. It was representing the upward trend, or the upward leg from the lows back here in November. And so once that support is broken, the role reverses. So support becomes resistance. And there you have it. It's one of the reasons why the sellers came in towards the end of the day, because you had the short-term traders who bought in at the low here, are taking profits up here. They're getting out. They're happy. And so that's point number one, is that it pulled back from that moving average as resistance. The second is the long shadow above the candle, as I just talked about earlier back here. And you could also see that the volume on the way up had been dropping. You see from this high here on Friday, the following, that's last Friday, and then last Monday, a week ago from today, we had that dramatic drop in volume, which is over almost a 30% drop in volume. And then we had another 50% drop from that following Monday. So we had a significant drop in the volume as the price is going up. So that's point number two. Point number three, who could tell me, let me see if I could bring up the Q&A box. I'm going to ask you a question. This will be good time for audience participation. But what do we call a long stretch of green candles like that? What do we call that? The long stretch of one green candle after the next. Anyone want to? There we go. Ken, Ryan, Amalia, Lloyd, Joe, Nathan. You're all right. You're all right. Thank you, David and Alan. That's called the stale green light. And I started talking about stale green lights back in actually when I was trading commodities. You would see this on candle charts as well. I coined this only because it was a great way to give people a visual, a picture of how they could relate to a stale green light. And I often use the analogy of you driving down the road at night and way up ahead, you see this green light, and you're in your mind, you got this long, boring drive on the straight, narrow road, and you're looking up ahead and you're going, well, eventually that light's going to turn red. So you get closer and closer, and it's been green a long time, and eventually it's going to turn red. And then you're right at the intersection, and you're starting to think, do I hit the brakes or I hit the gas, right? Well, that's what's happening here. We have this long stretch of green candles. So we are, as traders and even investors, we are anticipating the red candle to show up. So that's another point. The other thing is, not along with this shadow above the candle, you see this very narrow or small body. It's very close to a spinning top. You can call that inverted hammer, but that small body, excuse me, tells us that it's more or less a sign of indecision. If it was a commitment behind the buyers, it would be a long green candle with volume increasing as they would try to break that moving average as resistance. So we don't see that momentum building into resistance. We're seeing a fading of that. And so a weakening of the buyers tell us that a red candle is most likely going to show up. I would even guess that the red candle is going to show up tomorrow. And we are recording this, as I do many of the sessions, for evidence and proof that technical analysis really works. I was looking at the Dow futures today, and early in the morning when the markets first opened up, when the CNBC opened up to talk about the markets, the Dow futures trade through 24 hours. So whether it's a holiday when the U.S. markets are closed, the Dow futures continue to trade, and the Dow futures right around the time when the markets would be opening, Dow futures were down 113 points. Now, I don't know what the Dow futures are doing right now, but there is a good chance tomorrow we're going to see some selling action. And I believe that due to the shortened trading week, this selling activity is going to take place throughout the week, and I think it could push prices lower. So that's my spin on the diamonds. Now, I'm going to go right through these. I'm going to go to a more broad-based index, which is the Russell 2000. And I don't have to spend a whole lot of time on this because it's the same picture that we saw in the diamonds. The only one other thing I want to tell you is that last week's weekly market report, when I said the markets would rally, you have to understand that this rubber band effect, okay, the stretch from that moving average, you see that wide divergence below the moving average, this is very wide. And again, if you're brand new to the market, guys, or even a veteran of our teachings, then please always remember to compare the price of any stock as it relates to the moving average, so that you can see how far it's stretched below or above that moving average. And we all know from looking at charts week after week and month after month that stocks generally do not like to stay that far away from the moving average. The moving average, you can even look at it as a fair value for the general market or a fair value for your stocks. You might say, well, okay, where the stock is trading way below here, well, where would the fair value for that price per share be? Well, it would be near the moving average, somewhere up here. So when it's oversold, it'll eventually gravitate to the fair value, or it's more or less the market is going through this equilibrium. It's trying to find common ground or the balance between the buyers and the sellers, and that moving average does just that. You can see how often over the course of a year that the stock price or the market here in Russell 2000, how often it touches that moving average and crosses over it or crosses below it. So always compare where the price of your stock is to that moving average, and that'll give you a feel for or gauge whether it's overbought or oversold at that particular point. So right now, you could say that the Russell 2000 is trading right around fair value, or it closed on Friday right around fair value. And this too has a long stretch of green candles, stale green light. Therefore, I think that'll pull back as well. Quickly, I'll go to the spiders, SPY, and same thing, almost identical to the Dow right there, inverted hammer. Long shadow down here was a pretty easy call. In fact, it was last Friday night. No, it was not this past Saturday. A week ago Saturday, I was with some neighbors at our place in Cedar Key. Now, I understand I live in an airport community, so all of us are pilots. And when we get together, we're either talking about flying or we're talking about the stock market. It's kind of like one of those two things are going to be talked about around the dinner table, around the table when we're having drinks or whatever. And I had some friends who were heavily invested in the market, and we were talking about this. And this one fellow, John, first time, he didn't even know what I did for a living. He came out and asked me what I did. And my other neighbor went in the back room, pulled out my book, the 5 points for market, 5 points for trading success, handed it to John, and said, and John looked at me and goes, I didn't know this is what you did. And I don't talk about it really. When I'm on my downtime, I just relax. Well, anyway, we started talking about the market. He was getting really concerned because you got to remember, Thursday, he was looking at this big red candle. Friday, he's starting to panic because, look, we all saw the lows coming in right there for the general markets across the board. And he got spooked. And I said, John, just look at your positions. We went through some of his positions on my little smartphone. We were looking at charts. I said, I'll tell you what, next week we're probably going to see higher prices. We saw dramatically higher prices. That's a big 1 week rally, one of the biggest in the market's history for a 1 week move. And now he thinks I could predict the market. I don't know if that's good or bad, because I don't really predict the market. I know some of you might even seem confused about that. I don't predict the market. I read the charts and interpret the charts just like each and every one of us are trying to do right now. We're interpreting the charts to find out which side of the equation here is being affected more, the buy side or the sell side. Which side is weighing more heavily in the signals? So again, for next week, we're not talking about a major market collapse. We're just talking about an honest pullback and then possibly a bounce after we find some level of support for all the markets, not just the spiders and the diamonds, but also for the Qs. If you look at QQQ, that's the NASDAQ market. Look at this. The red candle has already showed up. You see that? Friday, we had a long stretch of green, but then we have an inverted hammer here, almost a spinning top, in red. And notice the volume increase on the red candle. You see? So this, too, is another easy call. So if you're new to market, guys, and you're looking at the markets and you're not sure what to do, then that chart right there is telling you protect. That's that. If the chart could speak English right now and talk to you like your smartphone Siri talks to you, and you say, Siri, which way the market's going to go next week, this chart is telling you there's a higher chance the market is going to drop. I'm going to do this. Hey, I'm going to see if Suri knows. Hey, Suri, which way is the market going to go next week? Let's see.
I can't get information on the markets for March 4th, 2018, but here's how things stand as of last Friday.
There you go. Suri told us how it was last Friday. She's not telling us where it's going to go. And the charts are doing the same thing. This is what happened on Friday. And it tells us that the sellers came in with force to push the buyers back, and the buyers were not able to rally or hold the rally that happened during the course of the day. So thank you for allowing me to bring Suri into the equation here. I hope that helps you out. Okay, let's get right to the VIX, okay, because this, in my opinion, is the most important indicator that we're going to look at. And by the way, if you have questions, before you submit your stock symbols, if you have questions about what I'm talking about right now, go right ahead. Type them in, all right? You can type those in, and I'll work the questions into the conversation here before we get to your stock symbols. Well, let me back up. I'm going to do what's called 3D charting. It's three-dimensional charting. What we do is we start off looking at the monthly 20-year chart. And you can see that for the longest time, we had been holding record lows right through 2017 into this new 2018. Record lows. And for the longest time, I've been telling people, watch out for a pullback. And I kept saying week after week, and especially to the option traders, I am a cautious buyer. That was my stance for many, many weeks, and in most cases, months. In my reports, I was telling people I'm a cautious buyer because the VIX was telling me to be cautious. When the VIX is on historic lows, it means that the markets, particularly the S&P, that this is matched to, tells us that the S&P is on record highs. So they're inversely related. Now look at the spike that we had back here last week, and you can see that this spike is very, very close to what we saw in the big spike prior to the sell-off. In fact, it superseded the big spike that we had in the sell-off of 2008. See, right here. And then towards the end of 2008, volatility went to record highs, topping over $90. Now we came to 50. Now, for those who are trading the VIX, to go from 10 to 50, otherwise a 500% increase in the VIX, that's a jolt. That is an emotional jolt to the markets because investors have been enjoying this fantastic bull market. All the analysts are saying we're due for a correction, we're due for a correction, we're due for a correction. Correction was not happening. And then all of a sudden the correction happens, or a correction happens, and boom, people are almost surprised by that. So volatility spikes. Now, that's the monthly chart. Now let's go to the weekly chart because it's going to look slightly different. And this is the way I would encourage all of you to look at the VIX. See, now we're taking a smaller sliver of that 20-year calendar, and we're now taking 3 years out of the 20, but we're breaking it into weeks. Now, look, last week, that red candle was pretty long. And if you look back in history, you'll notice that with every big spike that we've had, the volatility index has sold off after the big spike. Now, remember, again, if the the volatility index is expected to sell off, that's inversely related to the S&P. So if we're expecting the volatility index to drop, then we can expect the S&P to rally. Now, let's zoom into the daily chart. Let's look at this now, because that's going to be, again, a different picture. I said that we were probably going to sell off. Last week I said this. We did sell off. But now, why did I say or put a forecast out based on the charts? Why did I say the VIX is going to rally? Because the VIX on Friday came to the penny of this role reversal support level. Back here, it was resistance. It broke through resistance right there. It pulled back to new support, because remember, resistance, once broken, turns to support, and we're probably going to get a bounce. After that bounce, I think we're going to start to pull back again, which could cause the market to rally up a little bit. But that doesn't mean get back into an aggressive long position. You still have to stay very, very defensive in any of the long positions that you take, because at a moment's notice, things could shift. It could be, with Powell, the new Fed chairman, he might look at the consumer price index like we had last week come in higher and say, okay, consumer prices are on the rise. That means inflation. We got to start hiking rates. Okay, so the Fed decides to hike rates. Think about that. If the Fed starts hiking rates, what's that going to do to the national debt? It's going to increase national debt, because now interest payments on the debt are going to soar. And then that turns into a political argument, right? Now there's more uncertainty in the market. And then, boom, we could have another increase in the volatility index. You see, so this market is still not as stable as it once was 2 or 3 years ago when the bull market was continuing to rage. This, I would still say, is classified as a bull market, but it's a much more nervous bull market than it ever was. And while we're talking about bull markets, understand that this is the greatest bull market we've had in our lifetime right now. And with every bull market that ended with a tremendous bear market following it. And so I'm not trying to scare anyone out of the market. I'm just trying to tell you how important it is for you to remain a cautious buyer. And then when it comes time and you see all of the stocks across the board rolling over, not just their 20-period moving averages, but their 50-period moving averages, and then the 200-period moving averages, that's when you can no longer fight the trend. You have to now start to reverse your positions and start to make money on the way down, whether it be a bear fund, a contra fund, or an index inverted, an inverse related index fund or something like that. Then you could start making money on the way down, and probably make it faster on the way down than you did on the way up. Okay, that was only took me 22 minutes to go through the general markets. Now what we're going to do, I'm going to look at some of the questions and tell you when to go with regard to putting your stock symbols in. Not just yet, but David says, which is the strongest signal, rising price plus rising volume, or falling price on rising volume? They're both the same, actually, David, because the volume is confirming the force behind the move. So if you have rising prices with rising volume, it tells you that the buyers are very motivated. Now, if you have falling prices on rising volume, that tells you that the sellers are more motivated than the buyers at that particular point. However, with those things said, selling pressure is driven by fear, and buying pressure is driven by greed. So now I think we can change your question a little bit and ask, which emotion is the stronger of the two, fear or greed? And the answer to that would be fear. Fear is a much more forceful emotion, and it generally causes prices to drop a lot faster than they rally. And again, my case in point here is, look, it only took 1, 2, 3, 4, 5 days to drop. Actually, it took 1, 2, 3, 4 days after it broke through the 20-period moving average. It took 4 days to really hit the record one-day down moves. But then it took a whole week to recover what we lost. You see? So it took 1, 2, 3, 4, 5, 6 days to recover what we lost in 4 days. You see? And that is evidence of how fear is a much more powerful force than greed. Okay, thank you for that question. Paul asks, how will all this affect the metals? Good question. before I signed in, I looked at SLV. Now, I'm a big holder of SLV. Now, why isn't SLV coming up? And SLV and gold pretty much trade in tandem. But silver short-term looks bearish. Okay, short-term looks bearish because there's a gap down here below the market. But what I want to do is go to the weekly chart and show you something very interesting. Silver is in a triangle pattern. As the sellers converge in on the buyers, which are still driving higher lows, there's eventually going to be a face-off here, and my guess is that silver is going to break out to the upside because this is more or less a continuation pattern in the triangle form. If you look at GLD, I don't think I drew a triangle line on GLD, but this too is a triangle pattern. Look, I'll draw the lines here for you so you can see. All I'm doing is I'm taking the higher lows and I'm trying to connect as many as I can. I'm not going to go here. I'm going to take it from this low here and try to connect as many of these as I can like that. I'm going to try to draw like a mean between those right there. And then I'm going to project that a little bit more. Then you take the high and try to connect it to some other highs and project out. And there's your triangle. Now, while silver looks more bearish than gold, you can see gold here has a good green candle right as it's starting to break out to some highs here. I think this is one of those times where gold could rally, silver could go down. It's happened before many times. It could happen again. But what's happening is, as the Fed continues to hold their stance on interest rates increasing, what will most likely happen is inflation is a friend of the precious metals. So you're at a very, very interesting point in time, Paul, where the metals right now are starting to move with the markets, but eventually you're going to see them break away and do their own thing, most likely opposite or inversely to the market. Because what happens is if the markets start to fall down because they fear interest rates are going to cut into corporate profits, what will happen is investors are going to be looking for the safe havens to park their money. And silver and gold did very well in that last sell-off. And I don't know if you've been tracking that, but when we had that record one-day sell-off, gold and silver were holding, and they were holding fine. And I wasn't panicking. I wasn't. Anyone that had metals that day was not panicking. They were actually celebrating. So you have to watch because the geopolitical events are going to affect gold and silver more than the fundamental reports are going to affect the general markets. Okay, good question. All right, now we're going to start taking some stock symbols. I'll get to your question, Ken, here in a minute. Alan is looking at Ford. That's a stock that we are holding. This is a weekly chart. Let me go to the daily chart. Before I go to the daily chart, look, what's this called? 1, 2, 3, 4, 5. There's 5 red candles in a row. That's a stale red light. Okay, so now I'm going to go to the daily chart, and you can see that Ford is trying very hard to bounce off of these lows. Now, you're in at 1061, so you're right in at the close from Friday, and you have a stop at 10. That's not a bad stop. That's not a bad stop at all because I have to move my price axis there. All right, you have your stop down here. Now, I would probably give Ford a little bit more room than that. I mean, you could give a 61-cent stop loss order. Yeah, I think that would be okay. Yeah, 10 because I thought there was a lower low than what we saw last week. I would maybe give it a little bit more, maybe like 990 or something like 992 or some maybe a 991, an odd number. Because what happens is there's this thing called the power of whole numbers. Many people will put the stop at 10 or put a buy order to buy it at 10, while others will maybe try to buy a little bit better than 10. They'll put buy at 10.02. So if you keep your stop below the $10 psychological number. I think it could actually find support at 10. So I wouldn't want to see it go down to 10, trigger your stop, and then bounce off of that. So I would lower just a hair below 10, and that'll give you a little bit more room and out of the way of that psychological support level there. Okay, so I like that. But longer term, again, if you look at Ford, what I think is happening, and it has to do with some of the political comments that Donald Trump made at the State of the Union. If you remember, he is trying to rebuild Detroit. You know, he wants the U.S. to be the dominant car maker of the world, and Ford is giving. Let me tell you something. I'm a Ford guy. I don't want my emotions just because I love my Ford F-250. I don't want that to affect my investment decisions. But I have had no trouble with that truck. I love it. It'll probably go. I was going to trade it in for a new truck, and the dealer. Listen to this, and it definitely relates to why I like Ford fundamentally. The dealer said, I wouldn't trade that in. That's a good truck. You've worked out all the kinks while it was under the warranty. You got all the little things worked out. He said, you take care of this truck. You bring it in for the regular maintenance schedules, it'll go 600,000 miles. That's what he told me, because there's no reason for you to get rid of this. It's good. And the guy actually talked me out of getting a new truck. Now, you're not going to have too many dealers doing that, but that's someone who stands behind that product. Now, that's number one. You got the sales force. It's very, very pumped up. And if you don't believe me, step into any Ford dealership, have them show you at least one or two cars, even if you're not going to buy one, and look at how enthusiastic they are about their product. They are giving Hyundai a run for the money, although Hyundai's the people are going to go for more or less the cheap and not so much the meat. But Ford has a huge gap above the market up here around 13, and I think it's very likely that gap will fill. On the way up, there's minor gaps right here around 1150. So, you know, Alan, if you're in Ford, what I would tell you to do is, as it crosses over that 20-period moving average, and I think it will, as it crosses over that 20-period moving average, what I would do is move your stop up from 998 or whatever you have it up to just below 11. And then as it goes higher, trail the stop up, and then watch for the wide divergence above the moving average. So in other words, if the stock rallies and that rubber band stretches above the moving average, then you might start thinking about taking a profit to reposition yourself on a pullback. Now, that's the way a trader would do it. An investor would just hold on and do nothing. But we as traders are looking to make money from the up legs and the down legs. And so I think there's a lot of room here and enough volatility to allow you to get in and out and reposition yourself at the next new support levels. So that should help you there. Okay, question comes from Ken. Which candle pattern, if any, is the most reliable in your experience, i.e. bearish, engulfing, etc.? Well, there's four. I actually did a presentation on this, Ken, not too long ago. There's four of my favorites are the bullish engulfing, the bearish engulfing, the hammer patterns, the dojis, and the spinning tops. And whenever I see those, again, and how they relate to the moving average, I find them the most reliable ones. And so if you look, while we're on Ford, again, thanks to Ken, you can look up here right at the very top. What is that called? That is a bearish engulfing pattern. Right before that was a bullish engulfing pattern. See, after the bullish engulfing pattern, the stock rallied. Doesn't look like much, but it went from 13 all the way to 1360 up here, you see? And percentage-wise, that's a good trade. Now, on this day, the bearish engulfing pattern resulted in what? Oh, boy, a big gap after the analyst came out and said, well, we don't know what the guidance is on Ford, so we're gonna shy away from this. And this was an analyst blip right here. People made a knee-jerk reaction. The stock went from 1340 all the way down to 1020. Took a dramatic hit. But again, you look at the market, you look at the economy, you look at the tax reform bill that was passed. There's more money in people's pockets. You watch what happens after tax day, after April 15th, And while people start getting their tax refunds, you can see the commercials coming out. People are going to be buying cars. They have enough money to put on the down payment. The car companies are still financing with zero interest. You got all kinds of warranties and guarantees put on these vehicles, 100,000 mile this, 10-year warranty that, and it's going to get people in new vehicles. And I think that's going to help Ford. In fact, I had this conversation months ago when we were looking at Goodyear Tire, and the same thing happened. I talked to the guy in the tire store, and he said the busiest time of year for Goodyear Tire and the tire companies is after tax season, after people get their refund checks. And I think the same thing is going to apply. So without getting too tied up in the emotional whys and why I would buy Ford, the technical signals are still holding strong, and I think that's a good position for you. Okay, so hopefully that helped Alan and Ken with those signals. All right, now let's go to MO. That's Altria, used to be Philip Morris. And if you look here, what would be a good entry point for a longer-term investor? Okay, good question. And Ron, I'm glad you said that, because as a trader, I would say get in now and put your stop below here. But you mentioned the word investor. So I'm going to have to change my chart to a longer-term chart, because investors are going to hold it more long-term. Now, if you look at this, you'll see, you see my cursor moving around. That's because there's a dialog box there. The Q&A box, you don't see that, but it keeps getting in the way of my of my charts here. But if you look right here, I'm going to take this low, and I'm going to connect it. I'm going to go out. You see this? There's an upward trend, and that's a 3-year upward trend. Now, if I switch this to a 20-year monthly trend, look at that. You see this? You have an accelerated upward trend right here. Now, this line right there, this trend line, is significant, and you wouldn't see what I'm about to tell you if we were still on the weekly chart. Right here is a head and shoulder pattern. Okay, so while the trader would take a short-term long position, an investor is going to be much more cautious, because this head and shoulder pattern, left shoulder here, head here, right shoulder here, this is all part of the neckline. The neckline is the area of support that you want to watch out for. Actually, the neckline is going to be drawn right here. So if you get a break in this trend line, it's probably going to break the whole head and shoulders pattern and go lower. That's from the technical standpoint. Now, if it goes down to this neckline and bounces, then the stock is still, again, technically in the upward trend, which will support my long-term idea of Ford being a good value. Okay, that's not Ford, but MO being a good value. All right, so you have this upward trend, you have an accelerated upward trend, you have a key neckline support, but you have a head and shoulders pattern right there. So if it breaks down below that support level, all bets are off for the investor. And at that point, the traders are going to be short selling and taking their profits on the way down. Okay, so that's what you see on the monthly chart. The weekly chart, as I said before, is going to look like that. And this is not such a bad position, but I would say anywhere above this line right here, right? Anywhere above what's that price on the chart there? That's 60. Anywhere above 63.74, I think, is a good long-term buy for the investor in MO. But you're going to have to decide where you want to put your stop. Do you want to put it below the neckline? Do you want to put it below the shorter-term trend line? Or do you want to put it below the long-term trend line? You're going to have to pick one of these spots to put your stop. But right now, that's known as a harami on the weekly chart, so that looks pretty good. Okay, Roberta comes back with KHC. That's Kraft. Take a look at this one. Let me go to the daily chart now. Okay, so KHC. And Roberta, tell me, because it looks like a buy here, short-term buy because of the hammer pattern. But tell me, do you have no position? Is that what you mean? By when you typed in no position, you had no position? Or are you looking to take, I see there's no position, but are you looking to take a long position? Or are you looking to take a short position? Give me a little bit more to go on that. Okay, so you're looking to take a long position. Okay. All right. Now, that is a classic hammer pattern. And that goes back to the question that Ken brought up as to which is my favorite. Well, this is one of the favorites. And here's why. You have a wide divergence from this moving average, and this stock does not like to stay that far below the moving average. Even though this is a downtrend, I think this stock has a long way to go before it gets into an upward sloping trend. But for the short-term trader, this is a buy on the dip and a get-out point at the moving average. So we're looking for like from 780 up to 75.5. Okay, that's it. The area of opportunity that we're looking at right here. So if you get in on that hammer pattern, I would put the stop somewhere below that low. You don't have to buy that many shares, but put your stop below the low, and then watch the volume as the stock goes back up to the moving average. If the volume is dropping, then I would get out right at the moving average. If the volume is increasing as it's approaching the moving average, then you trail your stop up. That's how you would handle that one, and hopefully that helps you. Okay, David has LM. It's coming at LM. I'm going to try to get as many of these stock symbols done. And right away, I say buy this one. All right, so David says buy. LM is a possible buy because of rubber band and green candle on rising volume. Okay, I'm going to, now I just gave you the clue that it looks like a buy because immediately that's what my eyes are seeing. But I want each and every one of you in the audience right now to tell me all of the different signals that we're seeing on the chart that support the buy idea. Who wants to be the first one? Okay, Lloyd says gap. Absolutely. There's a gap above the market up here, right above 44. That's going to act as a price magnet. Who else wants to name a signal? Brian, absolutely. Engulfing pattern. It's a bullish engulfing pattern. I love that. It's a bullish engulfing pattern also on higher volume. Love it. Okay, Jerry, you're right. Bullish engulfing pattern. Herschel, absolutely right. It's got that rubber band stretching, so the rubber band is snapping back to that moving average. Absolutely right. Herschel said the gap, rubber band. Dylan says bullish engulfing. Amalia, exactly. There's a bounce off of the support level. You see that low right there? Well, if I draw that out sideways, what happened? Back here, this hammer pattern was a perfect bounce off the support. So you're all right. Everything that you've mentioned is what my eye picked up immediately when we pulled up the chart. So now, with the bullish engulfing pattern being 80% correct most of the time, and the hammer pattern down here showing a bounce off the support, and a gap above the market, knowing the gap rules tell us that 80% of the time that gap will fill, there's a really good chance the stock is going to rally. But what do we have to do? We have to prepare for the 20% of the possibility that we're wrong. So if you buy it here, you're going to have to put your stop somewhere below here. And that's how you handle that trade. So hopefully that helped you out there, David, and good luck with that one. All right, Ron, also we talked about MO. We got that one already. Dylan is coming up with the Qs. He has a long position in the calls, in June calls. Now, Dylan, if you remember what I just talked about with the analysis, I think that this is going to pull back. And June options are not a leap. It's not a leap. So you're going to suffer time decay because you're long the 171 calls, which are out of the money. So if you have any profit in this one, I'm telling you, if I had a long position, I'd be getting out on Friday. And obviously, Friday's past. But if you get any chance, I would get out of that, wait for a pullback, and if you get any kind of a bounce off of the support level down here, I would not go for the Junes. I would go for in-the-money leaps. And although they're more expensive, you're putting more of the odds in your favor because you're not going to suffer as much time decay. In options, cheap is not necessarily good. Cheap are the options that we're selling. Those that a June 171 call, I would be selling that against a spread. So be very, very careful. And remember, this is a recorded session. So if anyone is listening to this out there in the future, you'll have the advantage of looking at the charts after we did this report to see if that all panned out the way I said. Okay. Snapchat, Jerry is long the January 1913 calls in Snap, and this one's an amazing one because I think the social media pages are figuring out finally how to make money, and Snap is looking very, very good. The only thing I don't like, excuse me, I don't like this gap below the market. I don't like that at all. We took our profits in Snap. This is one of the ones that went out as a trade alert. We took our profits because you got the rubber band being stretched, you got volume dropping on the way up. Although that's a pretty good strong green candle, I don't see the volume supporting it. So if you own the January 1913 calls, those are in the money. And if you have any profits, again, like I mentioned before, I would seriously consider taking the profits. And then when the stock pulls back, you might consider selling a put spread or selling a covered put, a cash secured put, and getting back in on the long side after the pullback. So hopefully that helped you out. Okay, Roberta is looking. Okay, that's for your previous stock. Sorry about that. Is your moving average the 20? Brian asks. Yes, that's a 20 period moving average. Absolutely. And I like the 20 period moving average because it fits nicely and matches perfectly with the number of trading days in an average month. There's 5 trading days in a week. There's 4 trading weeks in a month. So you got 5 times 4 is 20 trading days in a month. That's why I use the 20 period moving average, no more, no less. It fits perfectly like a glove. Okay, looking for more stock symbols. Let's see. Okay, Alan asks, what is a LEAP? Actually, the acronym is LEAPS, L-E-A-P-S. And what that stands for is long-term equity anticipation security. That's what LEAPS actually stands for. And it's a way to get long a stock without having to pay the full amount of the share price. So we as option traders who buy LEAPS lay out far less money than those who are buying stocks. And before you just jump into the market and start buying LEAPS, please call me or go through a mentoring program with me or buy a book on option trading before you do any investing or trading in LEAPS. I strongly advise that you do that before you just start trading them. Okay, they're a little bit more advanced than the average buy and hold strategy that most are used to. Okay, looking for more question points. Okay, Tom says looking for an entry point in JD. Said that's not John Deere. No, that's JD. What is JD? Why is that not coming up? JD. Okay, JD.com. Okay, all right. This one, interestingly enough, is right at the moving average. It closed like pennies above it. Number one. So what I'm doing right now. Is I'm thinking out loud actually on this one for you. Okay, I'm looking at the different signals that would support either a buy or a sell idea on a stock like this. So I don't see a stretch from the moving average at all. So it's trading right at fair value. I see a red candle on low volume right? I don't see any significant gaps other than the one down here. It's a very small gap that would pull the market lower. I don't see a bullish engulfing pattern. I don't see hammers. I don't see spinning tops. I don't see dojis. So right now, Tom, I don't see anything at this point that would drive me either way. Okay, now, with that said, I do see more or less a roll reversal support level right around 42. So an entry point for me would be something like this. I would wait with patience for the stock to pull back to a key support level. Then I would look for a convincing hammer that would lead me to a buy idea, or I would wait for a pivot point off of that support level before getting in. So I would say an entry point would be either 42.5, 43 right here, or a gap fill point down here. If the stock goes down even further and doesn't hold the first level support that I mentioned, then the gap fill point is the ideal, $38.5 to $39 level. That would be ideal, because at that point, once a gap fills, there's an 80% chance that the stock will reverse from the gap fill point. So here's your two areas. So if you get in at this level, I would keep a very, very tight stop right below that support. If it blows through that support and doesn't give you the pivot point, then again, you would have to wait till it bounces off to this level and then put your stop below that support. Okay, so if you're a member, then you'll get the recording for this session and you won't have to take such hard notes. You just hit the replay button and remember what I just said. All right, bearish put spread. Ken is looking at a bearish put spread on USO. That's oil company. It's US Oil, and it's an oil fund. You can see that I've had previous lines drawn in here, so I'm going to erase all these to clear this up for you, Ken. Ken is looking for a bearish put spread on USO. Now, before we get into the technicals, Ken, have you been noticing that prices at the pumps have been going up? Now, this has struck me as quite odd, really, because it was just a few weeks ago, actually, that the economists were pumping the great optimism about U.S. oil as a whole. Our oil reserves have brought us from a company that was dependent on foreign oil to a country that is now supplying oil to the world. And yet prices are going up. And this does not fit well in my mind, because if we have such abundance in supply, why are prices going up? We should be seeing prices dropping for domestic users. Well, number one, they're taxing the heck out of it. But notice this. You have an upward trend that I'm drawing from this low back here in June. I'm connecting that low here. Watch what I'm doing now, right? Now what I'm doing is I'm going to accelerate the trend. See? I'm accelerating the trend. So we have two fan lines. Now this is a fan line. This is fan line number one. This is fan line number two. The stock is moving up to the moving average, and it's doing it very slowly. So I wouldn't put on a bearish spread while we're seeing the green candles. I would wait for it to hit that moving average or show any kind of a negative pullback from that. And then if you see the pullback, Ken, I would close that put position right here, because you're probably going to see a bounce off of that fan line. All right, you saw that happen back here. You see how it was going up, it pulled back and then bounced. This stock has a very much a rhythm that you could almost count on regularly, and so that's the daily chart. Now, if I pull back a little bit, I know I'm taking a little bit more time here. This is a 3-year weekly chart. And you can see that back here, it was holding support, but now it's closing below support. Let me see if I could do it this way. So I'm getting mixed signals here. You got to watch it. So hold on. Let me get the time. There we go. Price level. So right here, you see this was area of resistance, resistance, resistance. It's at a role reversal support now. So resistance was broken support. So you got green candles for the dailies. That doesn't support a bearish spread. You got it bouncing off support on the weekly chart. That does not support a bearish spread. And so you're kind of like in this place. Well, what do I do? I think you got to wait for it to pull back from resistance before you get into the 12-13 put spread. I think you'd do much better there. You know, quite frankly, I think there's better choices for a bearish put spread. You might even want to look at the spiders. You know, look at something like that. Remember, I was talking about the spiders possibly pulling back. You know, you could trade options on this. And although I don't trade the weeklies, I trade the monthlies. You might consider trading some weeklies because of this inverted hammer right here. So there's more evidence supporting a pullback in the S&P than it is in USO. Okay, got JD, got the USO from Ken. Tom is okay. We got that one, Tom. All right, David is RJF. Let's take a look at that RJF. Oh, I think I'm going to run out of time before I run out of stock symbols. All right, this is Raymond James, and Raymond James is right up there. You know, they're going to follow the Charles Schwab's and the E-Trade stocks, but Raymond James is showing a very convincing bullish engulfing pattern. And I don't know if you have a position on this one, but that one looks pretty strong for a buy. And Raymond James is in an upward sloping channel. You see this? You got the support level here, but you got the channel line up here. See how they run parallel to one another? So there's a good chance that you're going to see a run up in Raymond James. As an option trader, I would be more inclined to trade the calls on this than to trade the outright stock. I don't know if you have an option. I think you have an option position, but an option account rather, but you might want to look into that instead. All right, let's see. Just I get time for maybe one more. Anyone want to type in one more stock symbol, and that'll be the last one. Whoever types in the last one gets the analysis. Okay, got a little bit of a delay there. And 1, 2, 3. Okay, that's Ken. Okay, got your answer. David, you got your answer. And I see another one coming in. There it is. SLV for more detail. All right. Now, let me tell you what I'm doing. All right. Because I feel it's important that I disclose my position so you know I'm not going against my own words when I analyze this. What I'm doing, because silver has been in this, it's more or less a sideways pattern for so long. It's just been oscillating here. Even if I go back for 20 years, silver has more or less been trading in this range, from 20 down to 12.5, back up to 20, back down to 13. It's in this long basing pattern here. And I'm not trying to profit short-term on silver. My goal when I sell silver is to immediately buy back more shares on the dip. So my strategy is to accumulate more shares through my trading efforts. Does that make sense? Because when this thing goes to $100 an ounce, and I think it could do that, then I'm sitting on a multi-million-dollar stockpile of silver. That's my goal. So I'm basically what I'm doing is I'm using short-term swing strategies to accumulate a long-term investor position. And that's how I look at silver. Every time it goes down, I try to buy more to accumulate more shares. When it gets overextended to the top, I sell out. But I can't tell you how many times I sweated it out because I sold out on some kind of candle that looked bearish, and then the thing goes up, and now I'm thinking, oh, geez, I'm going to have to chase it at a higher price, and now I'm going to lose the shares that I worked so hard to accumulate. So I'm just trading it to accumulate it, and that's my strategy. But long term, you see this triangle pattern that I talked about. If you look at some of the other triangle patterns, like back here, this was a triangle pattern that was very powerful breakout. This was back, you know, when 2008 was taking place and 2009 was starting to get in. This was the key area to be buying silver, right around 20 bucks. And boom, it popped up all the way almost to 50. You see, so this is what I'm looking for in the trading triangle. And so this still looks good, and that's my spin and why I remain more bullish than bearish on silver and then the rest of the metals. And I hope my exuberance here didn't persuade you too much to just go, you know, sell the house to buy silver. Okay. One last one. I'm just going to squeeze one in there for Alan. He's looking at Boeing, ticker symbol BA. This is a defense stock. This is a one-day chart. This looks pretty bearish right now, Alan, because you got that spinning top right there on lower volume. So as the stock is going up, this is probably going to fall right in line with what's happening with the Dow. And Boeing is now caught between two fairly extreme fan lines right here. So if Boeing drops below this fan line, you could almost be certain that it's going to drop to the next fan line in that sequence, which would be a big hit for anyone holding Boeing at that particular point. Well, folks, like I said, did not run out of stock symbols. I ran out of time, and I had a lot of fun. I hope you did too. I do this each and every month. For those who are joining the Market Guys again for the first time, stay tuned to the Market Guys website where I'll post the next link. I'm going to try to do that tonight, actually. Post the next link for the next registration so that you can immediately go there, reserve your seat, and then the system reminds you with an email so you could put it on your calendar and not forget. So have a good rest of the week. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.